Greetings, this is Chapter 2 of Video 1. Let's launch. Okay, our learning objectives we're going to have in this video today is going to be identifying filing requirements for individual tax or income tax returns and statute of limitations for assessment. And then we're also going to outline the IRS audit process and how returns are selected for the different types of audits and what happens after the audit. In my opinion, this chapter, and I'm just going to say this before we get going, I think this is where we make our most money. And when I say most money, I'm not talking about, hey, it's all about do, re, mi, emphasis on me. What I'm more talking about is our value that we give to our clients. When your client gets an IRS notice, they freak. They get very stressed out. They get anxious. They think they're going to get dragged out in the middle of the night and sent off to a camp to go make big rocks into little rocks. And it's our job to tell them, for number one, calm down. It's probably not as bad as you think it is. There's probably just a mistake. All we have to do is be able to get them towards that. And so we're going to talk a little bit about how that is, and also how the filing requirements are kind of a basic thing that you need to understand, but the audit procedures are also going to be kind of important. And like I said, they're going to be a very valuable tool that you're going to have for most of your clients. All right. So the filing requirements, corporations must file regardless of taxable income. You got a corporation, you got to file. No ifs, ands, or buts. This is whether you make money, lose money, whatever. You got to file. Okay. It's all over with. Estates and trusts, you're required to file if you do gross income taxes if they exceed $600. We don't talk about estates and trusts very much in this class. I'm just kind of giving that to you just so that you guys have kind of an idea as to what the requirements are for them. And then an individual's filing is determined by filing status, age, gross income. So, and it's also dependent on the type of income. So if you have over a certain amount of investment income, even though it may not be over the gross income number, you still have to file because there's going to be certain requirements as a result of that. All right, so this is going to be where we kind of talk a little bit about the gross income threshold requirements. I'm not going to read these to you. Basically, it is what it is. There's not much you can really do with this. And so the biggest thing I'm going to talk about is if you do married filing separate, if your spouse files a return, pretty much you're going to want to file a return even if they don't have a whole lot of income. They really need to get that. And I know that there's a number up there, but the most important thing to understand is that if you got a married filing separate situation where the spouse is filing a tax return, you're going to need to file a tax return. And the reason why the IRS kind of does that is they want to make sure that everything ties together and makes sense. And so, people aren't trying to double claim things or claim things that they're not supposed to be claiming. So for example, you may have a situation where you just have two people who cohabitate. They're in the process of going through a divorce, but they can't get themselves to go down to the courthouse. So they just kind of delay, but they want to do married filing separate because their assets are now separate from themselves other than the house itself. And so they make a payment on the house. We'll say that one spouse does all the payments, but the title is in both names and they both agree, look, we're going to split this up 50-50 because according to tax law, we're supposed to do that. But, if you can also make an argument, hey, I made the payment on this and I want to take that tax deduction. There's certain other rules that kind of get into this. I don't want to get into it completely, but what they don't want to have happen is that one spouse doesn't file, one does, and then the one that does file claims everything. And then the second one who had a legal entitlement to claim that, because their tax return wasn't filed, it can cause some issues. And so that's one reason why the IRS does that. All right. So then this is going to be, some additional gross filing requirements. I'll just go past on that. So tax return due date, individuals 15th day, the fourth month of the following tax year. Why they can't just say April 15th. I mean, 99.9999999% of individual taxpayers are going to be calendar year taxpayers. I think I don't even know if they're allowed to do fiscal year anymore. I know that there was in the past that you were allowed to do that. I don't know if they're allowed to do that anymore because I think the IRS probably has come to the conclusion that there's no reason why anybody would do this other than tax deferment. So they want to make sure they do that. C corporations is going to be 15th of the fourth month of the following of the tax year, corporations can do fiscal. And, I have a couple clients where we've got partnerships that they do fiscal year. And so it actually ends up working out pretty well for them in that sense. Again, so, you've kind of filed that and you kind of move on. Partnerships are going to be 15th day of the following month of the third month. So, and let me translate some of this into English. If you have a calendar year C corporation, it's going to file April 15th. If you have a calendar year partnership or S corp, it's going to file March 15th. Okay. And if they defer that by, having a different fiscal year, you can kind of do the math to kind of figure that out. Due dates on Saturday, Sunday, and holidays are extended to the next business day. That is generally the case. I've seen where there was a court case where the IRS was allowed to deny a refund to somebody who had filed and it had arrived on Monday after the date that it was that the extended dead that the statute of limitations ran out. And the argument that they made was, well, it landed on a Sunday. They actually lost that court case. It's kind of very unique. I don't think that that's common. Most of the time when I've talked to the IRS about it, they've usually gone ahead and they've accepted it. I don't know if this time maybe the IRS was going to be out a whole lot of money, and as a result of which they just went ahead and they said, look, we're going to fight this because we want to keep, it's all about do re mi, emphasis on me. All right. Return due dates examples. Okay. So again, has it, if they have a, corporation has a tax year that ends on August 31st, the due date's going to be December 15th. Assuming a corporation file an extension, when would the extension due? It would be the June 15th of the following calendar year. And so you want to make sure that you're keeping all that stuff straight. And normally when you have a fiscal year, people will go ahead and they'll set up calendars in order to track all this because it can get real confusing. Statute of limitations, oftentimes when you file with an incorrect amount in the taxpayer's favor or the government's favor, statute of limitations, you actually have 3 years of the later of the date when the return was filed or the original tax return's due date. So, for example, if you file a tax return on February 15th, your statute of limitations is going to be on April 15th, 3 years hence. Okay. If you file a tax return on October 15th, it is going to be 3 years from the October 15th. Basically what's happening is the IRS, they're saying, look, in the first 3 months of the year or first 4 months of the year, we're processing a lot of tax returns. We don't have, we extend that. And it's actually based on that due date. And so if you file later than that because of an extension, the IRS still wants their 3 years in order to be able to go through this. And I'm going to tell you something. I actually talked to a buddy of mine who works at the IRS. He says, other than the normal stuff of, murder, sexual harassment, and all the other bad stuff that people can do to get fired, the one thing that will get you fired faster than anything else at the IRS is busting statute of limitations. It's something they do not take they do not take lightly. They take it very seriously, and as a result of which the IRS will watch that like a hawk. Now, does that mean that if I get within 6 months of the statute of limitations, does that mean I don't have to worry about this? No, the IRS can come back to you and say, look, we're filing a grievance on this. We're going to get this. And oh, by the way, we're going to ask you to do a letter that basically allows us to go ahead and extend beyond statute of limitations. And if you don't agree with it, we're going to assess the tax as of it is right now. You're going to pay right now. You work with us, we'll get you a better deal. Maybe they'll get a better deal. Maybe they won't. But so oftentimes the taxpayers kind of put in a bad spot if they don't take that extension. And oftentimes they're kind of pressured into that. Okay, so this is an example. Bill and Mercedes filed their 2016 tax returns on September 6, 2017 after receiving an automatic extension to say October 16th. When is their statute of limitations? Again, it's 3 years hence from when they file the extension. The extension due date means nothing. It's a farce when it comes to the statute of limitation stuff. What you've got to be careful of, actually, what's more important is that you need to make sure that you are taking care of the fact that that it's actually due October 16th, but the statute of limitations are going to start 3 years from when it was filed. So IRS audit selection. This is the biggest question I get from clients. What are my chances of getting selected for audit? And I never tell them that. I never tell them an answer. I dodge around it. I don't tell them this. And here's the reason why. If you're asking me what the odds of you getting audited, you're probably asking me because you're not doing things on the up and up. And then I start wondering whether I still want you as a client or not. But it does something, there's sometimes where, like, for example, if a client does get selected for audit, they're like, why me? Poor is me, blah, blah, blah. They're always picking on me, blah, blah, blah. And I'm like, well, that could be the case. Generally, it's not. And here's the process that they do. So the IRS uses a computer program to select returns that might have an understated liability. And there's actually a few systems they use. Number one is the discriminant function called the diff system. You'll have a diff score that'll be recorded, and if your diff score is at a certain level, they'll probably more likely than not want to take a better look at that tax return to make sure that everything's on the up and up. And things that are going to affect your diff score: how much are you taking in state, local taxes as a deduction? Now it's not a big deal because it's maxed at $10,000. But in the old days, if you file a tax return, you're taking $60,000 in state and local tax deduction, but your income is only maybe $230,000. They're going to say, that's a little high. Now, of course, if you're from the state of New York, maybe more likely. If you're from, Kansas, probably not as likely. And so as a result of which, they're probably going to be like, yeah, okay, whatever. Document perfection program. This is going to be the source of some of your audits. Basically is that if you didn't do the math right, again, probably not as much as it used to be, because let's be honest, most of us are not building our own tax returns anymore. We either go through TurboTax or we go through CPA or something like that, and they're building it on a computer. And as long as the mathematical things all line up, everything's going to be good. Now, sometimes you will have changes that go from one year to the next. Maybe I didn't claim a couple expenses on a previous tax return, but the IRS allows me to go ahead and change the carryovers, and I just go ahead and I just modify the carryovers. Well, there's going to be a math error there that the IRS is going to be like, wait a minute, whoa, you told us there was $40,000 of carryover. Now we're looking at $50,000 of carryover. What happened? And then they may come out to you and just say, hey, explain this. You send them a letter and say, this is what happened. And they kind of go, okay, fine. We're happy. We're okay with that. Then there's the information matching program. So this is probably going to be the most common source of your audits that you're ever going to have. It's called CP2000. You'll get a CP2000 notice. And the CP2000 system is basically saying, hey, you told us you had interest of $10. We have your bank over here that's telling us you had interest of $30. You didn't report correctly. Where's this other $20 of income? Now, if it's $20 of income, sometimes the IRS might be like, okay, yeah, whatever. But if it's significant enough, and this is where it usually happens. I have a guy, we do a lot of military people here because I'm prior military. So I get a lot of reservists, and they'll forget to give me their W-2. And of course, maybe we forget to ask them for it. Maybe they give us our stuff at the last minute. We kind of throw everything into the tax return and we forget to ask them about it. We actually had a client, this did happen to him. He didn't get us his W-2. I thought it was because he was getting out. It turned out he's like, no. I'm stayed in the reserves. I haven't done anything. I'm going to get out this year. And I'm like, oh, okay. I thought you were already out. And so I didn't bother to ask you for it. And then he didn't file his W-2. So he got a CP2000 notice saying, hey, W-2 wasn't filed. This is what you need to do. And this is how much we think you owe and blah, blah, blah. Now we ran it in our own system, find out whether the IRS said that he owed was actually way more than what he actually owed. And we were able to do an amended return, got it fixed. He paid, I think it was like an extra $500 in tax. He was fat, dumb, and happy, and that's all good. So we don't have to deal with that too much. I mean, like I said, usually when these CP2000s happen, it's either because the client forgot to get you something, or, it also could be, and I've seen this at other firms, obviously haven't had it happen here yet, knock on wood. But the fact of the matter is that sometimes you may unintentionally enter in the wrong number. Okay. And sometimes you're not checking it very closely. And the client's basically like, well, the CPA obviously knows more than I do. That's the number that he put in. If he or she even bothered to look at your tax return at all. I've had clients where I've thrown them a $400 page tax return, and they look at it and they're like, yeah, I'm just signing on the dotted line. I'm like, you don't even want to go through it? And they're like, no, I don't want to go through it. I'm going to trust everything you do. And I'm like, wow, that's dangerous. But, because sometimes we make mistakes too. And that's sometimes the way that the clients do it. And so it's important that you review the tax, and of course, if you work at a professional CPA firm like we do here, my staff prepares, I review. That way we remove a lot of the mistakes that could take place. You work at some of these other firms. Like I remember when I was at KPMG, it was reviewed. It was reviewed by me, it was reviewed by the preparer, reviewed by the reviewer, and then reviewed by the senior manager. So there's like 4 levels of review. That's something that's actually kind of extreme in my opinion. I think you only need, prepare, detail review, tech review, and then it should be gone. That should eliminate like 90% of your problems. And so that's the way that should happen. So again, different types of audits. You're going to have correspondence audits, office examinations, and field examinations. Correspondence audits are going to be your most common audit, conducted by mail, generally limited to 1 or 2 items on the return. I would not agree with that last statement. I just had a correspondence audit that had somewhere in the neighborhood of 15 different items and it was these pesky PTP K1s that this guy got. He got a whole bunch of them, didn't bother to give them to me. And of course they were all brand new, purchased in the year. We didn't know about them. And so he didn't give them to me because he didn't know that he was supposed to report anything on it because he just did whatever his financial guy told him to do. That sometimes happens. And so, what ends up happening is we say, okay, we're going to rerun the return, see how much we think that you owe, because the IRS always inflates their numbers significantly. And then we kind of get that. And so that's a very common thing. The way you're going to answer it is you'll probably rerun an amended return, make sure the math on the IRS is correct. And then if it is not correct, you're going to write a letter, attach an amended return, send it back to the audit, to the notice location, and then everybody's going to be happy. And the IRS normally will be like, oh, okay, yeah, we get it. Okay, office examinations are going to be your second most common. I actually have been lucky here at Beta Solutions. We haven't had one yet. Again, knock on wood. Hopefully I don't have any more of those. Because I did participate in an office examination at a previous firm that I worked at. Basically the IRS shows up. You show up to the IRS's office. And then basically what they do is they say, okay, these are the 10 things we want to ask you about. Bring in your, and they'll tell you ahead of time what they're going to ask about generally. Normally they're not going to try to surprise you too much because they want you to bring in the documentation. Their hope is to wrap this up in the first run, because you have to understand, why do you think it goes in this level? And the reason why is because cost. Cost is 99% of this. And it's not just cost to your client, it's also cost to the IRS. If I do a correspondence audit, it's probably pennies on the dollar, because all I got to do is pay for stamps, and I got to pay for the paper, and I got to pay for somebody to review it. Most likely than not, it's going to be pennies compared to everything else. Office examinations, I got to take an IRS agent, I got to put them for an hour in front of you in order to go over all this stuff. And that can actually add up to a lot of time. So, and then field examinations, I got to go tell the IRS agent, you're going to go spend the entire day at the client's office. And then, it's just more and more time. And so, like they said, it could last months or years. The only field examination that I've ever participated in was actually with one of my first clients that I had, and it was a mess. The guy had filed his tax returns completely wrong, messed a lot of things up. They didn't understand anything, and then he hired me to clean everything up, and we got everything taken care of. And it took probably about 9 months to get everything done. Expensive for him, expensive for me, expensive for the client, expensive for the IRS. It was a bad day. Okay. This is going to be the appeals and litigations. That's a little smaller than I thought it was going to be. So I'm going to go ahead and pass on that. So trial level courts, these are going to be some of the courts that you could be dealing with. You could be dealing with U.S. tax court. Now, the U.S. tax court is a national court. They're tax experts. You don't pay the tax at first. I want you to understand, the tax court is actually an administrative court. It is a court within the IRS, within the executive branch. And what they do is they try to balance what the IRS is saying against what tax law is. Now, does that mean that they always favor the IRS? No. I would probably say, sometimes they do. But generally speaking, they're going to apply tax law exactly as it is. Every time that I've ever dealt with the tax court, and every time some of my friends have dealt with the tax court, they're very fair. If you owe money, you're going to owe money. Now, I will tell you, I did actually get to go visit tax court. If we were in class, I'd actually try to arrange for a trip for us to go, but unfortunately we can't do that now because of COVID. But the tax courts, there's actually a tax court location downtown DC. One of the cool things about tax court is, I remember talking to a judge, and, the judge was, I remember talking to him, and I said, so what are your typical cases, blah, blah, blah. I said, Most of my typical cases are the taxpayer ranting about how they think this is completely unfair. I let them rant and then I tell them they owe the money anyways. That said, there's some times where they actually deal with some really complicated stuff. And, they'll come back and they'll say, no, IRS, you're not right here. The taxpayer has a legitimate reason for going against this. And there's a lot of cases where the tax court goes against them. I don't want you to have an impression that because it's an administrative court in the executive branch that they're always going to rule for the IRS. That is not the case. I will tell you it is the cheaper way to go generally, because here's the cool thing about this. CPAs can get certified to serve as representatives at tax court. It's an actual certification. You got to pass an exam so you can kind of become like a mini lawyer, and you can go and represent, you go play lawyer. I shouldn't say play lawyer because it's very serious, but you can go be a lawyer at the tax court and help your clients in order to be able to get out of the mess that they're in if you think you've got a pretty good thing. Now, the U.S. District Court is a local court, possible jury trial. Generalists, you will have to pay the tax first. So if you go to the IRS and you say, look, I'm going to take you to district court. I know I owe you $50,000. You better strike a check for $50,000 or else they're not going to take you to the district court. Okay. And then this is where, no stink, true story. You got to get lawyers involved. You want to be able to get, everybody, you're going to need tax professional lawyers. Definitely this. You're probably going to want the same thing at the tax court level too, because you want to make sure that you're doing things correctly. And lawyers, obviously, this is their bread and butter. It's what they eat for breakfast. So that's good for them. The U.S. Tax Court of Federal Claims is a national court. They're generalists. You do pay the tax first. The appeals to the U.S. Circuit Court of Appeals for the Federal Circuit. So if federal court claims doesn't give you what you want, you appeal it to the Federal Circuit. For the U.S. Tax Court, there is an appeals process. Unless it's an S case. If it's an S case, pretty much it's going to be dealt with and it's going to be done. Let me back up a little bit. Between you, me, and the fly in the wall and the NSA agent who's got to watch this video, watching this, more times than not, these things are going to get solved before they get to court. In my experience and in my experience of my friends, more often than not, if the IRS thinks that there's a way to get rid of this, they're going to do it because, again, it comes down to cost. I know it sounds weird. Most of the time we think of federal government, we're not thinking about cost, right? They got unlimited resources. Not exactly true. If you can get settlement before you go into this, and that's actually what ended up happening with this field examination I was telling you about, we eventually settled. And the IRS was like, look, we're going to go down all this stuff and hey, we're going to cut you a deal here, here, and here, but this goes away. And you're going to pay this much money. I went to the client and I said, look, client, don't take this the wrong way, man. I think it's the best deal you're going to get. My recommendation is stroke the check and move on. And luckily he did that and we were pretty good. Generally speaking, lawyers get together. They want to cut deals. They want to get this thing because if you go to court, it's drawn out. It costs money nobody wants to pay. And unless you're talking about like millions and millions of dollars, you're probably not going to want to drive this all the way up to the Supreme Court. Now, there are certain times that the IRS and the courts rule against something that is generally against the rules. And sometimes what ends up happening is it's because certain levels of courts can only do certain things. And so if you have to do it to the Federal Appeals Court, maybe the Federal Claims Court did something wrong. Federal Appeals Court can overturn that. Maybe there's something that the Federal Claims Court didn't take into consideration that the Appeals Court will take into consideration. They can overrule on that. And so there's a lot of reasons why you would want to choose one court system over the next. My recommendation is that if you have a client who's going to be going to courts, you get them a lawyer and make sure it's a tax lawyer that you know and trust. And it's not a bad idea to have a friend that's a lawyer that you can refer them to so that you can make sure that they get good advice and move forward. All right. Then it goes to the federal judicial system, the Supreme Court. Obviously, we all know about that, the highest court of the land. U.S. Court of Circuit Appeals, which is the 1st through 11th circuits and the D.C. circuit. You have the U.S. district courts, the tax courts, small claims court, tax court, small claims court. That's the one that you have no appeal. I knew tax court you could appeal, but I couldn't remember what the name was of the tax court, small claims. Small claims, we call those S cases, and usually they're for less than $50,000. And so what ends up happening is you go to there, you say you want an S case. The cool thing about S cases, usually it's just the judge and the taxpayer sitting down, and they're going to basically say, okay, what's your gripe? And oftentimes in S cases, that's where that judge says, I let the guy kind of ramble on talking about how it's unfair. They got to pay all this taxes, blah, 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 so on and so forth. Now, if your client's good and they bring you in and you're very good at handling the law, you can go to an S case and you can basically be like, these are the legal reasons why we think we shouldn't be paying this tax. You might get the judge on your side on that. Sometimes the IRS will be there. Sometimes they won't. I've seen in the past where it goes both ways. I don't necessarily know if one's better than the other. At least in the couple cases that I've seen where it's happened, I think it was split either way. So, I mean, it is good what it kind of is. These are the geographic boundaries for the U.S. Court of Appeals. Obviously, if you take a look up here, you'll see, I think we're in the 4th Circuit, if I'm correct. And I can't read that because on my screen, it's actually very, very small. But we're in the 4th Circuit. And so, now here's the problem that you run into is that if the 9th Circuit agrees to something and the 4th Circuit agrees to something completely different, normally what happens is it goes to the Supreme Court in order to come up with an idea. But until that resolution happens, if you live in the 9th Circuit, you get to take taxes one way. If you live in the 4th Circuit, you take taxes a different way. And that's going to be kind of important if you got a client who's living in one geographic region over the other. Generally speaking, it doesn't happen that significant. And if it is, it's usually going to be a big deal. People are going to know about it. They're going to talk about it, and they're going to have all that stuff worked out. And then it's going to be how it works out with your clients. All right, so this is the circuit, the 2 of 2. So this is the U.S. District Court jurisdictions for the states with more than one U.S. District Court are also depicted in the example. For example, Washington State is divided into Eastern and Western districts. I used to live out there in Washington State. I'll tell you, the cultural differences between one side of the Cascade Mountains and the others is like completely night and day difference. On one side, you probably have some of the, politically it's far more liberal than, the other side is, but and all that sort of stuff. Culturally, it's probably a very logical divide that the courts did. It's not depicted on the U.S. Court of Appeals for the District of Columbia and U.S. Circuit Court of Appeals for the Federal Circuit. Again, and I think probably because the main reason why is that D.C. is like this big at 10 square miles. So, it is what it is. All right, folks. So that's all I've got time for today. I want to say thank you very much and looking forward to you at the next class.